Hello, I'm Jonathan Moyes, Head of Investment Research at Wealth Club, and today I'm with Bill Nixon of Maven Capital Partners to talk about the Maven Income and Growth VCTs. Hello Bill, welcome back to the studio.
Hello Jonathan, good to see you again.
So for those who aren't familiar, could you give us a bit of background to Maven and your own experience?
So Maven is a fund management business, first established in 2009, following a buyout from Aberdeen Asset Management PLC. Over the kind of 12 or 13 years from 2009 to 2021, we substantially grew that business to cover a number of asset types and classes, but still with a focus and a specialism in VCTs. And in 2021, Maven was acquired by Mattioli Woods PLC. I've been a VCT fund manager since the early 2000s, and I've been the manager of the Maven VCTs over that period. And I've probably spent now most of my career, in fact, I have spent most of my career working in the private equity industry, mainly in VCTs.
So we're here today to talk about the Maven VCTs. What do they aim to do for investors?
Well, the Maven VCTs are generalist VCTs, long-established VCTs. The primary objective is preservation of capital and income. So, our objective is to try and build a broadly based portfolio of mainly private companies, but also AIM companies, and gain a regular flow of exits, new deals and exits, and importantly, pay a 5% dividend a year, tax-free.
So what types of companies are you looking to invest in?
We're complete generalists. I think the question is more what type of companies don't we invest in? But because we have a very extensive reach across the UK, we've got teams in most of the key UK cities, we see a very large number of companies every year. The type of companies we invest in, it's largely management driven, it's management quality, but we like businesses which are not fad based, sticky revenues, businesses in growth sectors, broadly based teams, all of the usual. And those companies as well that are available at the right price, because notwithstanding the more challenging market we're in just now, there is still a lot of capital in the system, and we still see some examples of overpaying.
And you tend to avoid more cyclical businesses. Tends to be a feature of Maven. Is that right?
Yeah, I think that's a fair comment. I think the sectors that we like the most, you've heard me say this before, but I'll say it again for completeness. We like software, very sticky revenues again. We like healthcare, we like cybersecurity, data analytics, training. Sectors that are, not dependent on consumer spending. We have one or two e-commerce businesses, but given the uncertainty in the market just now, it's a sector we're avoiding for now.
And what about management teams? What are you looking for in a good management team?
Well, I think we're looking for a number of things. We're looking for people that have done it before, either for another investor or within a corporate. We're looking for people who will reference well. And we're looking for balance. We're looking for, all the key disciplines. Often the challenge with younger companies is it's very strongly dependent on one person. And part of the growth challenge is to broaden that team resource.
So can you give us some examples of recent investments you've made in the VCTs?
Yeah, we've been really busy this year, notwithstanding, what's happening in the market. We've just completed our 11th private equity investment of the year. We work closely with other venture capital trust houses. But the most recent deals we've done a snapshot of those as BioRelate, which we've completed in the last few days, which is a deep tech biomed innovator. XR Games, which is an immersive gaming business based in Leeds, which works with some of the largest global brands such as Sony. And Orca Health, which is a digital health business based in the northwest of England, where there are some very, very high profile, high net worth investors also backing that, including Sir Terry Leahy.
You've got quite a large portfolio of investee companies. What about some of the more mature holdings? How are they performing? Any particular highlights?
Yeah, I think what we're now seeing is post 2015, when the rules changed. I think we're seeing the winners starting to gravitate to the top. And I'm pleased to say we've got a number of assets that have done really well in the last few years. Companies such as Bioscent Discovery, which is an integrated drug discovery compound storage business. Rockar, which is a software business for the automotive sector with customers such as Toyota and BMW. And beyond that, Bright Network. Bright Network is a platform which acts as a conduit, a bridge, between employers and emerging young graduates. It's now expanding internationally, and that business now has more than 700,000 students on its platform.
So how are you sourcing all of these investments at Maven?
Well, I think when you've got a presence in the local regions, a lot of the deals naturally come to you. We probably see a couple of thousand companies across our network a year. When you're in cities such as Manchester and Newcastle and Edinburgh and Reading and Bristol, you're able to build relationships with local advisors, local corporate finance advisors, and relationships are what drives deal flow. So we are big proponents of the regional model, and that helps drive deal flow. Often, it's a competitive advantage.
And besides funding, what are you offering investee companies? How do you help them succeed?
Well, we offer them support. We've got several, and that support can take a number of forms. We've got several very experienced aftercare executives. So we'll help companies with contract negotiations, with internationalization. We'll help them with banking. We'll help them find new customers, find new executives. If there's any gaps in the team, find a chairman. But one of the key value add that we offer is at the time of exit. We have highly developed relationships with key corporate finance advisors. We know which advisors are best in which sectors, and often we'll make an introduction to the company. When all parties consider an exit is appropriate, we'll make that introduction to help drive an exit.
And changing topic slightly, 2022 has seen a more volatile environment in markets. How's that affecting the way you invest, and how's it affecting your investee companies?
Well, 2022 has been more volatile. I think we're definitely seeing, a reduction in the price that buyers will pay. We're not yet seeing a reduction in the aspirations that management teams have in terms of pricing, but certainly buyers and international buyers, and we've sold quite a few businesses to US buyers. I think US buyers are being opportunistic at the moment because the market has changed, although the dollar is very strong, which helps ameliorate that. But definitely there has been a price adjustment in the market, and we're conscious of that. How we're addressing it is, as we've always done, we'll generally take a downside preference whenever we structure an investment in a new company. So that means that if the business is sold for less than all parties hope for at the outset, our clients can still make a positive return.
I guess that's a key feature of private equity investing, is you can have those structures, whereas on AIM, it's ordinary shares only.
Yeah, and we also invest in AIM, but we're being very cautious in AIM at the moment. I think at times when the markets are difficult, the quality of companies coming to AIM suffers. So we have an AIM team, and we are believers in a hybrid strategy, because private companies and AIM-listed companies have very different liquidity characteristics. Private companies take longer to mature and be sold, whereas AIM-listed companies, you've got technically daily liquidity, and that can sometimes be helpful in terms of supporting a dividend program. So we're believers in the merits of that hybrid strategy, and you do tend to get different type of companies that go to AIM. So I think if you've got the resource, personally, I think that's the optimal VCT model, investing in both private companies and AIM.
And have you felt the need to revalue the portfolio at all, given the falls in wider stock markets?
Yeah, I mean, we have taken some provisions on the portfolio. We are naturally quite cautious investors. When we exit, we like to exit, at or ahead of carrying value. But yeah, we've been more cautious in terms of valuation. We've been more cautious in terms of structuring deals. But I know from experience, investment goes in cycles, and it will recover.
What are the biggest challenges you face at the moment as an investor?
The biggest challenge, well, I've been asked that before, and I don't think it's really changed. I think the biggest challenge is winning the right deals in the best companies on proper financial terms, and finding those companies and structuring them properly, and also finding the best people. Private equity it's a very aspirational career for young grads and executives in the finance community. But the good people are always strongly in demand.
And how risky is your part of the market? How risky are your VCTs?
Well, private companies, are inherently risky. Earlier stage investment is inherently risky. But we have a really, really rigorous approach to A, asset selection, and B, portfolio theory. Portfolio theory, going back to my earlier point about hybrid investment, we have very large and diversified portfolios. Mm-hmm. You will get businesses that underperform. Equally, you will get businesses that materially overperform. So at individual company level, yes, there is higher risk. But if you look at VCT level, if you have 90 or 100 companies per VCT, the risk is addressed through portfolio theory.
I guess that's a key feature of the Maven VCTs, is just how many companies you invest in.
Yeah, and different managers take a different approach. Portfolio theory is a cornerstone of our approach. I don't like to expose any more than about 3% at cost of the VCT to a single company. It may grow to be worth more than 3% of cost, but that's another reason why I'd like to see the VCTs grow in absolute size every year, because that allows us to continue that portfolio theory, that expansion of the portfolio, and that ability to cover individual company risk.
And what about exits? Have you had any exits recently?
Yep, we've had a very strong period of exits. We had a really high-profile AIM exit earlier this year, a business called Ideagen, which was acquired by HG Capital. But we've had 3 private company exits. We sold an old economy business, Armec, to Centurion Group, trade sale. We sold a business led by our Reading team initially, called Cardinality, which was a telco tech business, which was sold to Finnish trade acquirer. And we sold a business called eFundamentals, which was a retail shelf data analytics business, to a similar business in the US backed by private equity for a combination of cash up front and paper in the enlarged business. So it's been a really active spell for realizations.
I suppose that's an advantage of having that large portfolio, is that there's always potentially some mature companies coming up to exit. You get that steady stream.
Well, it's the portfolio theory point all over again, Jonathan. That where you have a large portfolio of companies by absolute number and by sector, there are always going to be people interested in them, and that allows us to generate regular exits in support of our dividend policy. And all our VCTs have a dividend policy of 5% a year tax-free, and I'm pleased to say that in the last 12 months, all of our VCTs have achieved or meaningfully beaten that 5% dividend target.
Are you confident you can continue to achieve that going forward?
Well, first of all, I can't make a forecast on dividends, as I know you'll appreciate. But history suggests, every year we've had a number of exits. Over the last 10 years, there have been a number of exits every year. And if that continues, it's the intention of the manager and the boards, the VCT boards, to maintain that policy.
So how's the performance of the VCTs as a whole? How are they performing?
Well, over the last, I think I looked at this recently, and over the last 12 or 13 years, going all the way back to 08-09, the great financial crisis, I think other than 1 year, the Maven VCTs have generated an uplift in total return NAV every single year. So very steady state. We don't have large spikes in NAV, but we have consistent progressive growth in total return.
So to sum up then, Bill, for those who want to invest in a VCT this year, why should they invest in the Maven VCTs?
Well, I think investors should consider a Maven VCT as part of their investment this year because we have access to different deal flow because we're a regional business. We're a hybrid business. We invest in both private companies and AIM. So I think we give investors access to a really large, diversified portfolio. We've got a very experienced team who've been doing this for a long time. And we've got an attractive dividend policy. Furthermore, our team have made, and will again this year, have made a very significant personal commitment to the Maven VCTs. So our interests are entirely aligned with investors.
And you're sticking around after your exit?
I'm sticking around. That's my plan. I've committed to do 4 years, and I'm very committed to that. I'm enjoying working with Matthew Woods, and they're very supportive partners. And my plan is to remain as the VCT fund manager until at least 2025.
Very good. Bill Nixon of Maven Capital Partners, thank you very much.
Thank you, Jonathan.
If you are watching on YouTube, please press like and subscribe to the channel for more.